As we head into an uncertain real estate market, what's most important is you protect your investment now if you own a property and have a strategy to protect your investments in the future if you plan on buying one. Let's go over a few tips on how you do that.
If you're new here, my name is Ralph Nara, and over the last 20 years, I've been buying real estate and lending money on real estate for all types of properties. But I'm not here to sell you on me. I'm here to tell you how I did it. Over the last few years, I've amassed a short-term or Airbnb portfolio worth over $20 million. With that, it's allowed me to retire younger, replace my income from other ventures with all short-term rental income, and travel over and even own properties in other countries.
Instead of speculating on what's going to happen with the real estate market with high inflation, stock market down, interest rates up, everything kind of is going the opposite way of where we really want it to go. And instead of speculating on whether there's going to be a market correction, which I don't believe there's going to be, but I do believe there's going to be a housing correction, what I believe is most important for you is that you protect your investment if you own real estate and you set yourself up the right way if you plan on buying real estate. Whether it's a short-term rental, Airbnb property, or any kind of real estate, what's most important is real estate is a great long-term investment. So how do you set yourself up for the long term and get through the short-term pain? I'm gonna give you 3 tips on how you do that and how you protect your investment and put yourself in the right position for real estate investing. Number 1, avoid high interest rate debt and or pay that high interest rate debt down. The average interest rate as of last year and the year before, when we were in a good interest rate environment, was somewhere around 16%, and that was if you had good credit. So if you're borrowing debt on credit cards or short-term loans or business loans, the average interest rate was 16%. The average interest rate now over the next 12 to 24 months is going to be somewhere between 25 and 30%. 25 and 30% over time, even on a $1,000 payment, will cost you 4 to 5 times as much as you think to pay that back. That could be a death sentence when you go into a recession or a down market. Again, that is a death sentence. High interest rate debt is a death sentence when you're going into a recession or a high inflation market when interest rates are up. What's important to that stuff is that you pay it down or pay it off. For you, those of you who own real estate, I know you have a low interest rate if you refinance or you bought in the last 2 years of 3 or 4%. That's great, but if you're paying 3 or 4% on your mortgage and paying 25 to 30% on your credit card debt and you're accumulating credit card debt over time, it still will make more sense for you to refinance your mortgage, even if the rates are in the 6s and or 7s, than it will to pay your rate back at 25 or 30%. So it's important that you at least look at the options of a cash out refinance if you have the ability to take some of that equity out of your home and get yourself into one payment. The most important thing for you at the end of the month for peace of mind, quality of life, and long-term investing is to have a payment that's affordable and that meets your budget. Whether that's your mortgage payment or your overall debt payments, it's important that you have it. So one of the most important things when heading into recessions or down market is to have that high interest rate debt paid off or have it into a manageable amount through debt consolidation or a mortgage that you deconsolidate into so you have one payment that's affordable. So that's number 1. Number 2 is fixed payments and interest rates. In 2008, 2008, what killed most people in that market, what hurt most people in that market was adjustable interest rates. Not just on mortgages. Your credit card debt or short-term debt load is adjustable also and adjust to whatever the market rate is. You want to have fixed payments, a fixed mortgage payment, and fixed debt payments. There are loans available that are outside of mortgage you consolidate your debt into which worth one fixed payment. Whatever that interest rate is, whether it's 5, 6, 7, or 20%, you want to understand what that payment is every single month and you don't want it adjusting on you. When that payment adjusts on you, it's very, very hard to budget for. So what's most important for you is to have one fixed payment that meets your budget. Now, this is why I like debt consolidation into mortgages. When you consolidate all that debt and you don't charge it back up again into one payment every single month, you know what that payment is every single month and you can budget for it. When you have a mortgage plus credit card debt that keeps adjusting and accruing over time, it becomes a problem because you can't plan for what your payments are every single month. And this is when people get behind and they make mistakes where they have to sell off investments or go into more debt to pay that debt off because the payments are variable. You want the payment to be as fixed as possible so you can budget and plan. Down markets are not death sentences. What are death sentences when it comes to your financial status is if you don't plan and budget the right way. To budget the right way, you need fixed payments. So if you can fix your payments into one payment or one payment across the board, you will put yourself in a much better position on a go forward. Number 3, if you're going to buy a property, so now we're talking about if we're buying, right? So we got through all those things, we got our debt payments, we got the right budget, we found the payment that meets our budget, right? But if you're going to buy in this market, stop waiting for a crash or some catastrophic event where prices are gonna drop. Prices will be down, but you're not going to have a market crash because we're still in an excessive inventory shortage in this country of real estate, meaning there's still not enough homes for sale. So even though the market's down, we still don't have enough homes for sale. So you're not gonna have a market crash like you saw in 2007, 2008, 2009 of home prices dropping 30 to 40% because it's impossible and there's not enough homes for sale. What you can do to protect yourself is buy your home at market value today. Not what it was worth last year or the year before, or not what you think it's gonna be worth in the future. What's most important is you buy your home at market value today. Now, market value today, even though there's not enough homes for sale, is down from where it was 6 months ago and a year ago because there's not bidding wars. There's not a million people rushing to properties to buy them. So sellers don't have an advantage where they can say, well, pay over or waive your appraisal, waive your inspection, or I don't care what the value of the house is on paper, I can sell for this much. You have to make sure that you're going through with your realtor what the house is actually worth at market, what it's going to appraise for, what the houses in the area are selling for now and in the future. That's what you need to know more importantly than anything, right? You need to know what it can sell for if you bought it today and you had to sell it today. So if you buy your home at market value as of today, this month, right? Or whenever you're going to buy, you secure yourself into a home that's at proper value when you bought it. You're not buying, whether you buy it today or in the next year, in an inflated market. So even if that price comes down a little bit from now until then, it won't come down a significant amount. So buy your home at current market value and you are secure. So these are my 3 tips to help you with recession when it comes to real estate investing and securing your long-term future. Real estate, I believe, is still the best long-term investment. How you buy it is important and how you set up your budget is even more important. If you like this video and you want to see more like it, check out our YouTube page for the rest of our videos on investing in Airbnb. If you want to see something specific, leave us a comment, shoot us a message. I would love to hear more about it. Thank you for coming to our class. And if you want to know more about Airbnb investing, check out my course at thenextrealestategoldrush.com.